The Minority Market. Episode 69, Advanced Capital Allocation Strategies. Most people believe investing success comes from picking the right stock. The minority understands something far more powerful. How you allocate capital matters more than what you buy. Capital allocation is the art of deciding where money goes, how much goes, and when it moves. This skill separates long-term builders from short-term speculators. Capital is limited. Opportunities are unlimited. The mistake beginners make is spreading money randomly, following excitement instead of structure. They jump from one idea to another, chasing momentum, news, and tips. The minority treats capital like a scarce resource that must be deployed strategically. The first principle of capital allocation is preservation before growth. Your primary job is not to make money fast. Your primary job is to avoid large losses. When capital is protected, compounding works naturally. When capital is damaged, recovery becomes emotionally and mathematically difficult. That is why experienced participants always think downside first. Another key concept is concentration versus diversification. Beginners either over-diversify without understanding or over-concentrate emotionally. The minority finds balance. They diversify enough to reduce risk, but concentrate enough to benefit from strong convictions. This balance depends on experience, risk tolerance, and system maturity. Position sizing is the backbone of allocation. Not every idea deserves equal money. Strong opportunities with high conviction and low risk deserve more capital. Weak or uncertain ideas deserve less. Allocating equal money to every trade or investment is lazy thinking. Intelligent allocation weighs probability, risk, and long-term impact. Time allocation is equally important. Long-term investments deserve patience capital. Short-term trades deserve controlled capital. Mixing these two without clarity creates confusion and emotional conflict. The minority separates capital buckets: long-term wealth building, medium-term positioning, and short-term opportunity capital. Another advanced concept is opportunity cost. Every rupee invested in one asset cannot be invested elsewhere. Holding poor performers drains opportunity. The minority regularly reviews portfolios and reallocates capital away from weak assets towards stronger opportunities. This is not emotional selling. This is rational capital recycling. Rebalancing is also part of intelligent allocation. Over time, winners grow larger and losers shrink. Without rebalancing, risk becomes concentrated unintentionally. Periodic portfolio adjustment maintains risk balance and protects long-term stability. The minority also understands liquidity management. Keeping some capital in cash is not laziness. It is strategic flexibility. Cash provides psychological comfort and future opportunity power. During market crashes, cash becomes a weapon. When others panic, the prepared minority deploys capital intelligently. Another important principle is avoiding overexposure to correlated assets. Many beginners think they are diversified by buying multiple stocks, but all move together during market stress. True diversification considers sectors, asset classes, and behavioral correlation. This protects portfolios during systemic events. Advanced capital allocators also adjust exposure based on market conditions. During highly volatile or uncertain periods, they reduce risk. During stable long-term uptrends, they increase exposure gradually. This adaptive behavior improves survival and consistency. Capital allocation is also emotional discipline. It prevents revenge trading, overconfidence after wins, and panic decisions after losses. When rules guide allocation, emotions lose control. The minority also avoids ego-based allocation. They do not invest heavily just to prove they are right. They respect uncertainty. They allocate based on probabilities, not personal attachment. Another overlooked concept is reinvestment strategy. Profits must be deployed intelligently. Many people withdraw profits emotionally or reinvest randomly. The minority compounds profits into strong systems, long-term assets, and structured opportunities. Capital allocation is not static. It evolves with experience, market conditions, and personal goals. What works in early stages may change later. That is why continuous review is important. True wealth is built not by finding perfect trades, but by managing money intelligently over long periods. Small, consistent advantages in allocation create massive long-term impact. When you master capital allocation, you stop being reactive. You become strategic. You move from chasing returns to building systems. This is how institutions think. This is how long-term investors survive multiple cycles. This is how the minority grows quietly while the majority struggles emotionally. Remember, markets reward discipline more than intelligence. And capital allocation is discipline in action. In the next episode, we will explore how market cycles influence behavior and how adapting to cycles protects long-term performance.